because as we hear here, it's a confidence that's on the uptick, at least for the fourth quarter. What's changed? Because a 9-point jump is quite a big jump, for the quarter to have come through.
What we've seen over the last year was either retail banking or investment banking being under pressure, be it external market factors like Europe, Greece earlier in the year, or just pressure on the banking or the retail banking sector around lending costs, keeping that down, etc. What we've seen in the last quarter was the positive outlook for the retail sector, where impairments have reduced. Costs have gone slightly up, but it's partly due to headcount that it seems banks are starting to gear up for improvements going into the new year. And although investment banks' results don't look that good, there is an expectation that it will improve into the new year.
Of course, this rise coming through, and many optimistic about the road ahead as well. But where do confidence levels sit on a historical basis?
We've been doing the index for the last 10 years, and the long-term average is 62 points. So it's still well below the long-term average, unfortunately.
Absolutely. 12 points below that historical average. Volatility, we know, has been a key characteristic when it comes to this index. So one has to question the sustainability here. What's your view?
As I mentioned, I think the fact that all the indicators on the retail banking side is starting to, both on the top line and bottom line, are starting to show a more consistent improvement over a number of quarters. So going back in previous quarters in the year, you can see a steady improvement. It's a steady, not a fast improvement, but definitely improving trend. On investment banking, unfortunately, it has been a bit haphazard, where in one quarter things looked as if they're improving, and then just to fall back in the following quarter. So unfortunately, as we've seen throughout the global credit crisis, South African banking sector very susceptible to what happens internationally. Yeah. We have the uncertainty in the Eurozone at the moment, so I suppose the underlying indicators are looking positive at the moment, but if there's major shocks going forward, it will impact, unfortunately.
Let's for a moment distinguish between the two sectors, and if we hone in specifically on the retail banking segment here, because risks remain in the ability, on the one hand, for banks to increase revenue from interest income, and then on the other hand, fee income as well. So to what extent are you pricing in this risk factor as we move into 2012?
I suppose the index looks at it at a point in time. So unfortunately, although there's some indication as to the immediate future, it doesn't look at the longer term trend, and definitely there is a risk there. Although we have seen a slowly improving trend on both your fee and interest income over the last year, and as I say, that has been a steady growth. Together with that improvement in levels, bad debts and impairments, so I think the bottom line has a double benefit as far as that's concerned.
As you alluded to, I mean, we've seen increasing cost bases for these banks, and one of the banks that did come to the fore early this year announcing the need to raise fees is Capitec. I mean, it's the rising income costs that come at a cost to the bank, that it's forcing it to actually go down this route. Run us through the sense you're getting of management of costs in the banking arena.
We've seen with the 2011 results, the cost to income ratio was at historic high levels. Most of the banks, if you looked at the interim reporting, half-year reporting, showed some improvement in that regard. However, given the regulatory change that we're seeing internationally, banks have to invest in order to prepare themselves to comply with that on the one hand. But at the same time, costs have been contained through not employing resources. Standard Bank at the end of 2011 actually retrenching, but that's not sustainable if you're starting to see growth coming through.
Exactly, because it's interesting that you say that, because many banks had to increase their headcount to actually cope with the higher demand over this quarter specifically.
Exactly. And if you look at your non-secured lending, there has been a significant uptick in that, which obviously also requires additional resources to not only get the business in, but also to manage it subsequently.
Okay, so now let's hone in on the investment side of things, because as you highlighted, things remain very erratic on that front. What's your outlook moving into 2012? Because a lot is hinging on international development, specifically that out of the Eurozone economy.
There's definitely still pressure on the corporate finance, investment, private equity and stockbroking segments of that business. So the trading activity has been quite buoyant in the last quarter, but so it's very dependent on the activity in those segments. What we've seen throughout the credit crisis was companies take a wait-and-see attitude, especially with uncertainty in global markets. So the expectation, or it's very dependent on where the Eurozone goes as to whether that activity will pick up or not in the next year.